It's time to focus on seniors with Helping Seniors TV. The television show designed to make you aware of senior issues and needs, as well as to acquaint you with the resources available to help you age in place and with dignity. Now, here's your host, Joe Steckler.
I'm Joe Steckler, and welcome to Helping Seniors, the television arm of Helping Seniors of Brevard County. Our show is designed to provide you with information on how to develop your own aging and care plans. Our topic today is reverse mortgages, and joining me is Barbara McIntyre of Reverse Mortgage Funding. Welcome, Barbara.
Well, thank you very much. Nice to be here.
Yep. You know, we did one show before, and I think we did a radio show too.
We have.
And I have to admit, I didn't walk away from that radio show and a TV show with the knowledge I should have. And that's my own fault because, this is a subject that I, along with the majority of Americans, probably know very little about. We talk about insurance, we talk about health care, we talk about long-term care plans, we talk about interest rates, we talk about Al-Qaeda, we talk about all this stuff, and everybody's an expert on that.
Right.
But when it comes to some of the nitty-gritties that make up estate plans, or something that we should do a better job of planning for the future, and I think I discussed this with somebody else on another show about estate planning. I think reverse mortgages, especially with acquisition of our home, is going to become a major part of our retirement planning for the future with the changes we have in our country today.
I think you're right. And I think a big reason that it hasn't been so well understood or spoken about so often, and definitely much misunderstood, is that for many years a reverse mortgage was considered a mortgage of last resort. And it was the type of mortgage that people only did when they felt that they had pretty much depleted all of their retirement assets, and the only thing they had left was their home. And they were struggling with figuring out how they were going to get their medicine, at the end of the month and pay their bills. And so they went to their housing wealth. And what has really changed with the product is that, for one thing, a lot of people like myself have made a real effort to dispel the myths, to make sure people understand that things like the bank is buying your house from you and they're going to own your home, which has never been true.
But before we get into any of that,
okay.
I asked Barbara before the show, I said, Barbara, can you offer to our viewing audience your credentials? Why should they believe what you're saying about a reverse mortgage, a home equity line of credit, and some of the things we're going to talk about today? So please do that, Barbara.
Okay, well, I'm going to start by saying that my credentials begin with being a nationally licensed mortgage loan originator, which is a designation that anyone doing mortgages in the country goes to great lengths to study, take a very difficult test, and recertify every year to make sure we're knowledgeable about lending practices. Then we do the same thing for the state of Florida. That's the first thing. The next thing that we do is, as a reverse mortgage loan specialist, I pride myself, I can only speak to myself, and I believe in our industry many people do. The product is so unique that it's an obligation to fully understand all the different changes and things that have come along the way with the product. So we have organizations that give us opportunities to certify as a certified reverse mortgage loan specialist. We are overseen by an organization called the National Reverse Mortgage Lenders Association, and they've put into place a great deal of training and a certification process that allows us to get that designation. So that's the certifications that help us be perfect at what we do. Like I pride myself in saying I'm a subject expert. Sounds a little arrogant, but you know what? It's what I know. I'm not a financial planner. I am not they know so many things about so many areas, but I know this one product and how it could potentially fit into a bigger plan.
Well, that's why I thought it was so important that that we talk about this topic, because in talking to you, I quickly saw that there was a possibility that a reverse mortgage can be more beneficial maybe than a home equity line of credit for a number of reasons. And you showed me several graphs which illustrated the veracity of what I was saying. Mm-hmm. And I recently did a show with a financial planner, and she gave an example of two brothers investing money at a certain time in their life, and one doing it later, investing it longer. Mm-hmm. And the person that put the money in first and was the one that ended up with $1.5 million instead of $1 million, and the other one had $1.25 million. But, you know, it doesn't sound like a lot, but if we don't do a better job of planning now,
absolutely,
with the changes we've had in our country, as far as pension plans, retirement plans, retirement ages, Social Security, all the frights that the federal government has put in front of everybody. How about you just explaining to our viewing audience what a home equity line of credit is and what a reverse mortgage is, and then we're going to get some different parts of it.
Okay. Well, the home equity line of credit is a loan you would get from a bank that allows you to tap into equity in your house with the obligation that you're going to continue to make a repayment on it. You might be making an interest-only payment or an interest and principal payment, but you're required to make a payment. The home equity line of credit that you might get from a bank also has a period of time in which you can draw on it, and the bank can actually reduce the amount that you're able to borrow. Well, this is a pretty good loan for younger borrowers that are just wanting to maybe put a roof on their house, and they're still actively working, and they're in their 30s or their 40s, and they intend to pay this loan back right away. The reverse mortgage line of credit, I fondly call it a RELOC, is very similar to a bank's home equity line of credit in that it's just letting you tap into equity in your house. It's not part of your any loan balance until you actually draw it out. The good thing about it is it doesn't require a monthly payment, but you certainly can make payments if you want to.
But why wouldn't it require a monthly payment? Or I see I can see the home equity line of credit, and you borrow on that, and you're paying interest, and I can understand that.
Right.
When you get that reverse mortgage and you start about making payments, not making payments, and I think probably the average viewer of the show would probably not understand, like I don't understand.
Right. The reason it's a little tricky, Joe, is that it does a couple different things. The line of credit in a reverse mortgage has a feature to it that is unique to it alone. It is nothing like a home equity line of credit from a bank. The line of credit in a reverse mortgage, the lenders decided, I should say the government decided, because this is an FHA insured loan. It is an FHA mortgage. They said
all reverse mortgages are FHA, all of them?
Yes. Well,
okay.
We now have some lenders putting proprietary, what they call jumbo loans. There's not many, and that's for multi-million-dollar properties. It's not out there enough to even discuss.
Seems like that'd be risky, though.
Well, it's a whole nother topic.
Let's not talk about it.
But let's talk about why the line of credit or RELOC in a reverse mortgage is a little harder to understand. There's two things that go on with this reverse mortgage line of credit. One is, and this is what I believe the financial planner was mentioning to you, within this line of credit is built in a growth feature. It says that whatever money is available to you in the line of credit, it is going to be increasing at a rate of growth equal to an interest rate. The assumption of this loan is this is a borrower who is retired, who is only going to get older, because we all have birthdays, and who is in a home that is in a market of normal real estate appreciation. So if the home is, we can assume, is getting more valuable, and the borrower is getting older, and the entire loan is designed to give a senior borrower access to his own equity, then the loan itself says we are going to make this line of credit feature grow. It's just going to keep giving you access to more available equity. Like your financial planner mentioned with the example of the two young men, the reason the boy that started saving earlier had more money than the second young man who started later is because of compounding growth. And the same feature exists within the line of credit growth. So as the line of credit is growing, it's growing on top of itself and it's compounding. Equity is the difference of what's the value of your house and what you owe. So it's not money in a bank account earning interest. But you heard that expression, if it walks like a duck, if it quacks like a duck, that's exactly what it looks like. Because every month you get a statement and it says, here's your new principal limit. Here's your new ability to borrow. Ideally, what as an advisor and a financial planner would say this wholeheartedly, which is why I try to be a resource, ideally, these funds would stay available and strategically be used between other invested monies or retirement money, Social Security, pensions, so that you can actually prolong the overall wealth of this retiring person so that they don't have to worry about running out of money. And statistics show that more people are frightened of running out of money than they are of dying anymore.
Are you saying that if I have a reverse mortgage and I guess I have a hard time getting these numbers. You talk about building interest building and adding to the principal. Let's say if I had a $100,000 house and I borrowed $40,000 and there's still $60,000 left on the mortgage. Then the interest would be accruing on that $60,000?
If are you suggesting that you had a $100,000 house and you drew on the mortgage $60,000 out?
40 out.
40 out. So what's actually going to be paid back if you drew the 40? Then the 40 is your debt.
That's my debt, right.
And that is going to be accruing interest that will be repaid. Your $60,000 is equity that will just be there to be used for repayment later.
Where does the bank make their money?
The bank makes their money when the borrower, the last borrower on title, makes the decision to leave their home, and then the loan is repaid either by using another asset to repay it or by selling the home and repaying it. Then just like any loan, because this loan truly is just a lien interest like any mortgage, it would be repaid. Okay. That's when loans are repaid, when borrowers sell their houses.
So what is the advantage, or what's the good and the bad about a reverse mortgage?
Well, the bad used to be really easy to say, because many years ago, and I've been in this industry exclusively for 12 years, I would sit at the kitchen table and I would say, hands down, this is the most expensive loan on the planet. And if you don't plan to be in your house a good 5 years, we might need to look at other options because it is expensive. It's not a short-term loan. So if you see yourself in 2 years living with your daughter, then maybe we should reconsider. That was then, and that was the only real bad side. Because all the changes that have occurred due to regulations All of the rules that come out about this product come directly from FHA by mortgagee letters, which have been modified and changed and modified to protect the consumers against anybody doing anything inappropriate. And now we have limited loan origination. Many loans don't even have those costs. We haven't had servicing fees built into this product in many years. Our interest rates mirror forward lending very closely. And the consumer protections have really just made it a better and better product.
So why would a person want to take a reverse mortgage out?
Oh, for many reasons. One reason might be a 62-year-old who really does need to retire, but does not want to take Social Security benefits at 62. They'd rather wait and get 100%. So they may go ahead and do a reverse mortgage on their home so that for the next 5 years, they can draw what they would have drawn out of Social Security, so they can defer that Social Security, locking themselves into reduced.
But what kind of interest are they going to pay on that money that they borrowed for 5 years?
Well, they're not going to actually take it out of their pocket and pay it until they're gone. Their house will pay it back. But what kind of interest? It depends on what type of loan they do. It could be as low as 3.25%. It's hard to say. Most of our products are variable rates, and what they have is a fixed margin with an index, a LIBOR index like the U.S. Treasury that goes up and down. I have folks in mortgages that went into a mortgage 12 years ago that actually have like 1.25% interest today, believe it or not, because the index went down to less than 0.25%.
So it's their advantage.
Well, except for if they were wanting to use a line of credit and the growth rate, I would rather have higher interest.
Oh, well, yeah,
because
that's
it
true.
grows faster.
But I know you gave me an example once before. You said that you were going to take a reverse mortgage on your home because at your age, and it had to do with long-term care insurance.
That's exactly
How about
right.
explaining that to our viewers? Because
All right,
I think I finally, after you explained it to me several times, I finally got the point. But I think this is a good illustration of how why a reverse mortgage is better than a home equity line of credit.
Well, there's a lot of reasons why it's better, but this is another example of how it can be used. I briefly told you about the person using it to defer Social Security from 62 to 66, right? Now let's talk about someone like me. I turned 62, put a line of credit, got a reverse mortgage, the same exact mortgage, put in place a line of credit on my home. I love what I do. I'm still working. I have no intention of retiring.
You put a line of credit on?
I put a line of credit on my home, a RELOC, a reverse mortgage line of credit. I have no intention of drawing any of it out because I don't need to. I don't intend to draw it until I need it. What I'm thinking is that when I'm in my 80s, it's possible I will need long-term health care in my home. Based on, right now it's growing at 5.06%, but because of some inflation we're looking at, I know we'll see a higher rate of growth. Remember, it's compounding. I fully expect that line of credit to be well in the $300,000, $350,000 available equity to me that I will not requalify for, that will not be reduced by the lender like a home equity line at a bank. They can actually reduce the line of credit. If they think your house isn't worth as much, they'll send you a letter and say, we said you could have access to $50,000, but the market isn't so good, so we're changing it to $20,000. That can't happen in this mortgage.
Wait a minute.
Okay.
I heard you say home equity line of credit in two different ways.
Okay, the bank is a home equity line of credit.
Okay, what was the one you're talking about?
The RELOC, reverse mortgage line of credit.
Reverse mortgage line of credit.
Reverse mortgage line of credit cannot be canceled, reduced, or called due. The home equity line of credit, which is what most people are used to, all of those things can happen. It can be reduced. It's definitely going to be called due, and it requires payments. The RELOC has a growth feature built into it so that if you're not using it, it's increasing. Okay. And you never requalify for it, and it's never going to be canceled. And here's the one thing I haven't said. Of course, it's true of both loans. It's tax-free. It's not, you can't be taxed on it. There's no income tax on a loan. So when you do draw the money out, 0 taxes. Pretty nice.
And then how would that, you said something to me before the show, you mentioned 3 things.
Mm-hmm.
It was like a myth that something couldn't happen. You had to have 3 things. What were those things?
When the loan could be called due.
Yeah.
3 things. Not living in the home. You have to live there as your primary residence.
Okay.
Okay? You can vacation, though. It's not like you're a ball and chain stuck to the house, but it has to be your primary. The only 2 other things are you have to pay your property taxes and you have to keep homeowner's insurance on the home.
Insurance, property taxes, and
live there.
Live there.
Mm-hmm.
But the repayment part, let's say the heirs, if mom and dad do this, then they're going to short me and I'm not going to get what's my due.
The loan is designed with the purpose, with the intent of always having some retained equity in the house. Depending on how mom and dad draw the money out, will determine how much retained equity is still left in the house in the future. Because the loan is designed to leave retained equity, most of the time when the borrowers have finally left the home, either by deciding to or by passing away, when the kids inherit the home, because remember, the bank doesn't own it,
right?
Then the kids say, how much is the balance on the loan? What is the house worth today in that market? And there should be a difference that would allow the kids to inherit some money after the repayment of the loan. Because remember, it's just a loan.
Right.
But here's the good part. If for some reason mom and dad lived so long, the housing market came down again, if they live so long that the house would not be sufficient to repay the debt, the kids have no obligation to use any other asset the parents have to make up the difference to the bank.
Why?
Because it is insured by FHA, and the FHA insurance fund steps in to make up the difference. That's what makes a reverse mortgage work. Part of the costs associated with the loan right from the beginning was reverse mortgage and FHA mortgage insurance, and that's what it's used for. So,
if you think about it, this might be an instance where the government has done something smart. Mm-hmm. and the reason I say that is because if this thing works as you explained it to me, then mom and dad, as they get older, this provides money for them to live decently, and it still gives the children an expectation that there could be something left. It wouldn't be like just selling the house to put mom and dad in a nursing home or an assisted living facility someplace when they could be kept in their home where they want to stay.
Exactly. It's a really good option. It gives a family thinking about all the potential things that they could do to secure their elders' lifestyle. And most people really do prefer to age at home. And with home health care services available to give people assistance, it's just another way for them to tap into funds. And for boomers, this line of credit and its growth, strategic use of that, working with your financial advisor, absolutely might help protect us from, we've lost a lot of, the markets have not been favorable to people retiring. And so where everyone thought they were smart and had saved enough, there's a long line of people saying, oops, I thought I did great, but the markets weren't favorable and I've given a lot back.
This might be an argument that we could use to say that the purchase of a home early in life can be more of a mainstay in our retirement planning than we thought.
I really agree with that. That is something I really agree with. I just think that, the American dream, we've always talked about purchasing homes, but I think the thinking that really came from your generation, for the most part, was no mortgage, no mortgage, no mortgage. I'm going to buy the house, going to pay it down to no mortgage, and then my kids have this, I've established this legacy. And as time went on and the cost of living got higher, our homes, and especially the boomers, are probably our biggest asset for a lot of people. And so what FHA is now also doing, and I said we've constantly have changes to protect the consumer, and some of those changes are even slowing down how quickly consumers draw these funds out.
Right.
They've put some limitations in place. They won't let you take more than 60% of that initial benefit in the first 12 months. They really want to help educate these borrowers to plan for longevity planning.
Yeah, you know what you said a minute ago. I'm kind of like my generation that had just a little bit different thought. Mm-hmm. I wanted to pay my mortgage off, but I wanted to pay my mortgage off because I wanted to know what I could realistically plan to be put in place in the event of my death, so that my wife would live comfortably. Mm-hmm. I wasn't, the children, if there's money left, the children can have it. Mm-hmm. But my concern was my wife. And sure. I think a lot more of my generation thinking along that line, and I think that causes sometimes for children to feel that they're being excluded. But we all, I think, should earn our benefits, and I have never believed in the free lunch for everybody. I think that you need to earn what you get, and I think you have to have a good plan. But I think that this is one way to do a plan.
It's definitely a piece.
We're almost out of time. In fact, we are out of time. But was there any else that you wanted to say real quick?
Oh, I couldn't possibly say anything too quick.
Oh, okay. Well, okay.
It was wonderful, and I love bringing the information to the public, so thank you so much.
That's a good thing to say. I'm Joe Steckler. Thank you for joining our program today. I'd like to remind you that our senior information line is available to you at 321-473-7770. There you can get help and direction that could be helpful for your specific situation or circumstances. The work of helping seniors is very important, but we can't do it alone. That is why our sponsors here in Brevard County are so important. I'd like to thank our many area sponsors, businesses, and medical providers who support the mission of helping seniors that help us carry the cost of our media efforts. If you'd like to join us either as a business partner or simply donate as an individual, we would welcome your call at 321-473-7770. You are always welcome to visit our website at www.helpingseniorsofbrevard.org. Thanks so much for your help. It does make a difference.